What's up, traders? So today I'm going to discuss whether it's too late to get into Nvidia stock, and if I were to trade it today with their earnings coming just next week, how would I do so? Because there is definitely an amazing opportunity coming up here soon. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader, and I bring in multiple six figures a year from the stock market, and I use the money I make from the stock market in order to pay for the lifestyles of myself and my entire family of 8, because yes, me and my wife have 6 kids. So, pray for me. All right, but besides the prayers, what you could really do for me right now is smash that like button down there. You guys were incredible last video. I asked for 500 likes and you guys have it currently at well over 1,000. All right, so I believe that 1,000 has to be our new mark. So if you could, please, I need you to hit that like button so we can get over 1,000 likes for this video. And while you're doing that, you might as well subscribe too, because, why not? Do remember that I am not a financial advisor and this is not financial advice. All trading comes with risk. I'm just showing you how I've built wealth over time. All right, so checking out Nvidia, if you clicked on this video, I'm assuming you already know about Nvidia as a company, but they are chip makers and they make some of the most advanced AI chips in the world, and they are considered the leader in that space. But currently, Nvidia, ticker symbol NVDA, is trading at about $130. It's down about 1.5% today. And if we scroll down, we can see that they have a market cap currently of $3.2 trillion with a PE ratio of about 46, which is not bad for the amount of growth that this company has. And we can see that their next earnings date is May 28th after market close. Now, Nvidia's earnings is like the Super Bowl of earnings season. Ever since AI became a bigger thing after the release of ChatGPT, everybody really focuses in on Nvidia's earnings release. And they are always the last Mag 7 stock to report, so it ends up being a pretty big deal. And how they do, good or bad, can really sway the market one way or the other. But I believe that AI is still within its first or second inning. All right, up to this point, we've really only used AI for general things like chatbots. But sometime in the future, there will be a world where you walk outside and you see robots. Sometime in the near future, there will be a world where 10, 20, 30, 40, 50% of cars on the road are being driven by artificial intelligence. And because of that, although Nvidia has had a great run over the last few years, like the saying goes, a rising tide lifts all ships. I believe over the years, as AI continues to overtake our lives, that Nvidia will continue to benefit from this. But really quickly, let's take a look at their fundamentals. All right, so we can see here the last 5 years, the growth is insane. And this is exactly what you want to see from a company, is consistent growth. So we can see in the year ending January of 2021, they did $16 billion in sales. And then in the latest year ending January of 2025, they did $130 billion in sales. And then if we go to the net income side, 5 years ago, they did $4 billion in sales. And then this year ending January 2025, they did $72 billion in sales. So the growth is insane, but let's go ahead and take a look at what their expectations are for this upcoming earnings. All right, so we can see up here over the last 4 quarters, they have beat on earnings every single time. So we can see that last April, they beat by 13%, then July 8%, October 11%, and then this January by 7%. But we can see here the current average estimate for their earnings this quarter is 80 cents per share, which if they hit that mark would be 37% growth year over year. But we will find out next week if they do beat those earnings. I believe that they will. Simply because 1, they have a track record of beating, but 2, we've already heard earnings from the majority of their biggest customers. And for the most part, they've all said, we are still full force on building out our AI infrastructure. And that typically includes Nvidia's products. Now, looking at analyst ratings, there are currently 43 analysts who cover this stock, and they all collectively have it as a strong buy. Now, it looks like out of the 43, we have 36 strong buys, 2 moderate buys, 4 holds, and 1 strong sell, which is very interesting that they have one guy who does think it is a sell. And so that individual must think that the AI trade is over, but it looks like he's alone in that thinking, as they collectively have it as a strong buy. Now, as far as price points go, analysts currently have it as a high target of $220, a mean target of $166, and someone, probably that bearish analyst, has it as a $100 price point. However, when I look at these numbers, I typically pay more attention to the mean target. So what do they all think collectively? And they have it as a target of $166. And of course, we can see that it is trading below that amount currently. And so that is good to see. But let's go ahead and take a look at the chart. All right, so here for this chart, we are looking at the last 6 months, and these are daily candles, but we can see that it got to an all-time high just on January 7th. It got up to $153. And then, of course, as we know, the current administration came in and started talking about tariffs, and that brought the whole market down, and it got as low as $86 just on April 7th of last month. And then, of course, over the last month and a half, it has rebounded quite nicely. Now, hopefully you were buying shares or trading it while it was still down here in this area. Because what I find funny is that most people will very quickly repeat Warren Buffett's famous line, be greedy when others are fearful, be fearful when others are greedy. However, most people are never fearful when others are greedy and are never greedy when others are fearful. What usually happens is they're greedy when others are greedy, and then they're fearful when others are fearful. And so what happens is when stocks start falling like this, people are like, oh no, I'm not touching that stock. It's just going to keep falling down here. But then when it rises up here, they're super excited about it and very anxious to buy the stock. And that just baffles me every single time, because stocks are the only thing where people shy away from it when the prices are cheaper, but then get excited when the prices are higher. You know, it's like you love discounts on everything else other than stocks. All right. But we as a people have to change that mindset, because the people that do the best in the stock market are those who are greedy when others are fearful. And one of the reasons I love selling puts so much is because it helps me be greedy when others are fearful. All right, so when you are new to options trading, when you agree to sell a put, you are agreeing to buy shares of a company at a cheaper price than what it's trading for today. And for you taking on that risk, you are paid a premium upfront. And because every contract is worth 100 shares, then you are agreeing to buy 100 shares of that company per contract if the stock price drops to the level you agree upon. All right, so a quick example, if ABC stock is trading at $100 right now and you sell a put at $80, well, what happens is you get paid a premium upfront. So let's say you get paid $200. Well, if ABC stock, which is currently at $100, stays above that $80 mark, you just keep the money you were paid and you go about your day, and you can do that trade over and over and over again. However, if ABC stock, which is currently at $100, and you agree to buy it at $80, if it drops down below $80, then you will be forced to buy the shares of the company at the $80 mark that you agreed upon. However, you still keep that $200 you were paid. Now, going back to the discussion of being greedy, well, the only reason that a stock would drop from $100 to $80 would be because people became fearful. Well, now selling that put has forced me to buy those shares while others are being fearful. So that's one of the reasons I love selling puts so much. You just want to make sure that you do this on an actual company that you would actually like to own at the price that you would like to own it at. And when you trade it in that way, there is no stress involved. So that's what I think I will do, is I will go ahead and sell puts prior to Nvidia's earnings in order to collect the extra premium that is built into the contracts currently due to their earnings coming up. Now, again, especially dealing with earnings, you only want to use this strategy on a company that you really want to own at the price that you really want to own it at. Especially because with dealing with earnings, the market can be super irrational. And here's what I mean by this. If we look at these three numbers here, this shows us the performance of Nvidia stock the day after their earnings reports. So we can see that the last 3 times they had earnings, the stock went down. All right, February 26th of this year, it went down 8%. Then November of last year, it went down just 0.76%, which isn't much. However, it still is technically down. And then August of last year, it went down 6%. Now, I can tell you for sure, and we've already looked at the data, that those last 3 earnings, they had amazing growth. So why investors sold off the stock? Well, it's because they're simply irrational. Because with earnings, what also happens is a company can have horrible earnings and their stock can still go up. And we just seen that a few weeks ago with Tesla. Tesla had one of their worst earnings in years, and their stock skyrocketed simply because Elon said that he was going to kind of back off of all of the political stuff. All right, so investors are irrational when it comes to earnings. However, I believe that in the long run, Nvidia is going to go much higher. So if we were to sell puts, let's look at a few data points that could give us the best probability of profit. All right, so first things first, I like to look at the Bollinger Band. So the Bollinger Band are these black lines up here, but they just aim to show you the price range that a stock is expected to trade within. So the middle line is the 20-day moving average, and then the top line is 2 standard deviations above it, and then the bottom line is 2 standard deviations below it. But you can see about 95% of the time, the stock trades within the Bollinger Bands. And the times where it pops out, it usually pops back in. You can see it pops out for a few days, pops back in, and that trend continues on. However, most of the time, it stays within the Bollinger Band. So when I like to sell puts, I typically like to look at the bottom of the Bollinger Band. So we can see that this bottom line is currently at $114. So that is a number that I want to pay attention to. But also what I want to point out is that the 200-day moving average is currently at $126, which is this blue line here. And that is typically a very strong point of support. And we can see that it actually tested it today. We can see it today, it went down and kind of popped right off of it. So that is good to know. However, I'm going to use the bottom Bollinger Band number, which is 114. Okay, but that looks good. Let's head over to our next data point. So here we are at the expected move, and the next thing I need to do is select an expiration date. Now, if you are familiar with the channel, I usually go up to 45 days out. But specifically when dealing with earnings, you can often benefit by selecting the closest expiration date after the earnings. So obviously, since they report next week, then that expiration date would be the date that is 7 days from now on May 30th. And we can see that the expected move is about 6.97%, which would bring us to a lower price of $120.79. Now, normally between the Bollinger Band and the expected move, I typically select whichever number is more conservative. However, specifically when it comes to earnings, the expected move is typically a little bit more accurate. So in this case, I'm going to use the number stated by the expected move, which is $120.79. And so now let's head on over to Thinkorswim and look at my last data point. However, I typically always get the question of where am I getting this data from? The link is right in the description below. And when you use the link below in the description, you will get your first 30 days for free. So go ahead, try it out. I typically use this website every single day to get information from it in order to determine the best trades to take. So go ahead and get your free 30 days. The link is in the description below. And also, if you know anybody who could use help generating income off the cash that they already have, then tell them about the Trade to Freedom community. That link is also in the description below. But within the community, we have strategies all the way from 0 DTE for our day traders, all the way up to monthly income strategies for our individuals who are a little bit more busy. But not only will you get to see my trades when I enter them, but you'll get my full options course from A to Z. Thirdly, you'll be able to ask me questions at any given time. And lastly, you'll be within a community of other traders who all have the exact same goal as you. So if you know anybody who could benefit from it, tell them about Trade to Freedom community. The link is in the description below. But let's go ahead and head on over to Thinkorswim. All right, so here we are at the options chain for NVIDIA, and I'm going to go ahead and select the expiration date that we wanted, which was 7 days out. But if we look over here on the put side, we can see that this column here is the delta column, and the delta just aims to show you how much an options premium will move per $1 in the stock's price. However, most successful traders that I know look at delta as the probability of the event occurring. So if we were to look at a delta of 0.24, which is the strike of $123, that's telling me there's about a 24% chance that NVIDIA's stock price drops down to 124 by this expiration date. So in other words, you would have about a 76% probability of profit. Now, for me, I typically use deltas of 0.20 or lower. Now, if we look at the expected move that we wanted to use, which was $120, we can see that it has a delta of 0.17. So that would fit that criteria. Now, looking at the premiums, the bid and ask spread is $1.38 to $1.40. So I would receive up to $138 to $140 per contract if I were to open up this trade right here, right now. And as I said, we would just need NVIDIA stock to stay above $120 by next Friday. And if that happens, then we just keep the money we were paid and we go about our day. However, if NVIDIA stock were to drop below $120 by next Friday, then I will be forced to buy 100 shares of the company per contract that I have. And so you would just need to make sure that that is something that you are okay with doing. But if you're like, hey, Rashad, I have a smaller account, I can't really afford to buy $12,000 worth of NVIDIA stock per contract. Well, here shortly, I'm going to show you how to do a credit spread as well. But for my people who want to sell puts, I were to just come here and I'll go ahead and select the bid price, and your brokerage will automatically fill your ticket for you. And then you can set it to however many contracts you want to do. It's totally up to you. But for the purposes of this video, I'm going to do 5 contracts. All right. And if I'm ready to place the trade, I could just hit review and go ahead and place the trade. However, let's take a look at the P&L chart. All right, so if you look at that number at the top left, we can see that we received $690 total for opening up this trade. And these red dots here are where the price is currently. And as long as the price just stayed here, by expiration date, we just keep that money we were paid and we go about our day. If the stock price were to go up, we just keep the money we were paid and we go about our day. If the stock price were to go down some, we just keep the money we were paid and we go about our day. However, if the stock price were to drop below $120, which was the strike that we selected, then we'll start to make less and less money. And our break-even point is right here around $118. And if the stock price were to keep going down, then the contracts become worth less and less and less. However, remember, you were fine with just purchasing the shares at $120. So it's like either you get paid to wait around and it goes up, or you get paid to wait around and it goes down, and you also get to buy shares of a company that you really wanted to own at the price that you really wanted to own it at. And when you think like that, it's a win-win situation. But the key for it being a win-win situation is for you to do this strategy only on companies that you would really want to own at the price that you really want to own them at. And I can't emphasize that enough. Don't just go trading companies that have a lot of premium in them, because what I will tell you is there are no free lunches in the stock market. And if premiums are super high, there's always a reason for it. So please, if you don't actually know the company, if you actually don't want to own it, then do not do this type of strategy. All right, but now let's discuss credit spreads. All right, so credit spreads are very similar to selling puts. However, now you are adding a long leg a little further from the money. And what this does is it lowers the amount that you need to put on the trade while also lowering your max risk. And the exchange for that is that you'll make a little bit less money. But let's take a quick look at how that would work. So if we wanted to still sell a put at the $120 mark, we go ahead and load that up. But now let's say we want to add a long leg at $115 to make this a credit spread. So I'll go ahead and click this. All right, so now we have a credit spread. We are selling the $120 strike, and then we are buying to open the $115 strike. And so we are receiving $138 for selling the $120 strike, and then we are paying $66 for buying the $115 strike. And our max profit would be the difference between the two, which is currently around $78. So let's go ahead and take a look at the P&L chart. So the stock price is right here, and we can see that our max gain is around $78, $79. Even if the stock price goes up, if it stays the same, or if it goes down some. However, if it starts to go below $120, then that's when we start to make less and less money. And we can see the break even is right around $119. And then if the stock price keeps going down, then we continuously lose money on this trade. However, our max loss is capped once it goes below $115. And you can see in this case, it would be about $422 per contract that you could lose, because the max loss with credit spreads is always the distance between your strikes times 100, which in this case, our strikes have a $5 difference. Then we times that by 100, gets us to $500, and then minus the premium we received, which was $78. So that gets us to a $422 max loss. And we can see that the numbers are changing because the premiums are fluctuating as I'm recording this. However, that is an option for people who have smaller accounts or who just want to take on less risk. But that is a potential trade for NVIDIA's upcoming earnings release. Again, if you would like to learn from me, come on and join the Trader Freedom community. We would absolutely love to have you and help you make 2025 your best financial year ever. And that link is right in the description below. And please don't forget to go ahead and tap that like button. But that is it for this video. I will see you guys on the next one. Peace.